Hello and welcome to this month's discussion. Today we are going to cover quite a few topics that are timely, one being CPI and kind of digging into the core differences between core CPI and just the overall with all items, as well as what the Fed may be looking at and what indicators they're following closer than others, where we may see a pivot ahead, areas to avoid and areas to lean into in the market right now, and then some planning opportunities moving forward. All right, so Jared, do you want to get started?
Well, let's look at the lay of the land. I mean, it's been a terrible year for risk assets everywhere. It doesn't matter if you're in stocks, you're in bonds, you're in cryptocurrency, everything has gone down a lot. And that was kind of the goal of the Federal Reserve and the central bank, is to ease the burden of inflation. And with that, as Chairman Powell said, cause some pain. There's been a lot of pain. Now, as we get toward the end of the year, a lot of that pain seems to be over in a lot of areas. But if you look kind of what the Fed is watching closest right now is CPI. So if we take a look at the graph and maybe some of the chances for changes ahead, I think a little bit of different tone we probably have in this meeting today. So if you look at the graph here, you can see what the Fed is worried about overall. They talked about inflation being transitory, whether it's core or kind of headline. CPI has continued to rise recently. Having said that, with oil prices, commodity prices, a lot of the burden has slowed down, and you can see that overall. So if you look at taking the last 3 quarters of CPI, it's really close to that 2%. Now, if you dig in a little bit on the core is still around 6, and that's what the Fed's concerned about. But the biggest factor of that is shelter or housing. So let's talk a little bit, Michael, about maybe some of the challenges with housing and maybe some of the data we've seen recently.
Absolutely. So, and when you look at the CPI component, sort of shelter and housing make up about a third of that. And what we've seen lately, at least from the Fed perspective, is that the data that they're looking at for housing is very, very old. That, we just had the housing prices come out for August, and they were down a record amount. And what you see from that is, all right, so that data in itself is already, a couple months old. However, those are, just from the closing dates. These contracts, these prices were agreed to, probably 45, 60 days beforehand. So this data that they're looking at could actually be from, May, June, and July. So they're even, the data that is just that much older, and it doesn't really reflect today's current economic environment. So when you look at the housing affordability index, you've really seen this drop off to where, the idea behind this is to say, all right, if your benchmark is 100, that means that the average person with with a median income can afford a home at the average prices at current mortgage rates. However, we have to believe that that number has to be lower, because the data that the Fed is looking at is that much, is that it is already, 4 or 5 months old. So when you're looking at it from that perspective, to believe that the housing market is, worse off than where we think it is, we have to think that's very a plausible event. Because if housing prices say peaked in August, that means we know that September is going to be a bad number and that October is going to be a bad number. And from an inflation standpoint, it means that we really peaked back then. So, from an opportunity perspective for the Fed, they could look at that and say, all right, maybe this is when we need to start thinking about taking a pivot, taking a pause from an interest rate perspective, and then from there, really try to make a rational decision. The question that really comes out of this is, will the Fed look at the current data, or are they still going to use a lot of historical data that is already stale?
And Megan, when you look at, Michael says some of the criticism with the Fed about looking at core CPI and how it's gone up is the housing and the lag of the data. And when you look at mortgage rates in the last 2 months, it doesn't look like it's gotten any better. Activity seems slower, and everything is going to be down. So how do you look at kind of this overall activity? I mean, how much will prices go down on housing? When does this affordability and activity, pick up, I guess?
Yeah, I think we're just going to have to see a further decline in home prices. And a lot of that still, although it's starting to pull down, It's still going to take some time because everyone was so used to very high prices for so long, and the affordability was there for so long with such low interest rates. So it's going to take quite a few months probably for that to actually bake in to the data, and could continue to show this lag. To Michael's point, the housing affordability index in August already showed that it dips below kind of just the average affordability levels, but that's based on 2 to 3 months old data as well. So moving forward, we should see that dip even lower. I think we would say it would have to at least come down 10 to 15% more in prices, just with where interest rates are at, to keep your monthly payment still the same. And a lot of people are still, stuck on that home price that they wanted to lock in to move. So I think it will just be a behavioral adjustment people will make.
And to your point, Megan, the affordability is today's mortgage rate divided by old housing prices, right? So if this housing prices are 2 to 3 months old and you have current mortgage rates this high, the affordability is down. But as you get record price declines and they continue, mortgage rates, all of a sudden affordability picks up. So if we talk about historical inflation and look maybe at the symmetry historically on this, I think this is an interesting graph to detail maybe what's ahead from an inflation perspective. And if you look at this graph, it's very interesting to go back to different periods of time over the last 50 to 70 years on inflation trends. And it's very symmetrical. And if you look at the hard blue line of our current trend, June seems to be the peak right now. How quickly we go back down is really the debate between us and the Fed and trying to invest money over the next 6 to 9 months. But history suggests it's very symmetrical. And when you look at housing prices, I think today is a very big deal that you hit a record decline in housing prices. And we know that the next 2 months are not going to be any better. So the direction of housing prices in a lot of the commodities, which eventually will feed into that core and CPI numbers the Fed's concerned about, as we all are. But you can see what's ahead. The inflation is going to continue to fall over the next 12 months. So now if you pivot back to where you were going, Michael, a little bit, the Fed meets next week. What are they going to do? They raising rates? Are they going to pause?
Well, the statistics show that they're likely to raise 75 basis points next week. And that's really what's expected. Probably, still they have the data to support that kind of move. But then I think the question really lies in what do they do in December? Do they go for 75 or do they go for 50? And right now it's looking like 50, but if they know that the housing prices are going to be coming down a lot, or have come down a lot and are going to continue to come down a lot, and the one sort of component that they're waiting on from an inflation standpoint that's still really sticky are food prices, do they really need to keep hiking, 50 or 75 in December? I think it also raises the question, do they actually need to do 75 in November? You could make the argument that maybe 50 is okay. But again, you think right now you still have to take the Fed at their word that they want to see a string of months, consecutive months of flat to lower CPI numbers, and until we get there, that they could sort of stay on the course. So from a opportunity standpoint or investment standpoint, the question is, what's really your downside now if they do continue to say do 75 and 50 or 75 and another 75 versus say a 75 now and then a pause? So what's the risk to the downside in the markets, and what's your potential upside?
And now look at we're 2 weeks from the elections, right? So 2 weeks from today, Megan, we have elections. Let's maybe look at some current numbers and then what it means next year historically, right? Because we have a lot of data that suggests next year could be a pretty decent year.
Yes. So typically leading into midterms, regardless of kind of where everything's leading, normally the vote goes towards the incumbent. So with that being said, and since we're coming into it from a negative standpoint, the following 12 months on average is up almost 15%. So odds are that we could see that play out, and regardless of kind of where the Fed lands, we could see that ahead.
Wait, how many negative numbers are on this page next year, right? So that you've
That would be 0 out of 20, and out of the 20 instances, 0% chance of negative returns. But that's, you know, historical. It's not guaranteed.
History is no guarantee of the future, as we all say. You know, looking at past performance, trying to project. But as you set up to what you said, Michael, looking to what the Fed likely can do and getting this really big record housing price decline. If we really believe the Fed at their word that they're going to be looking at the data and indicators, this is the first humongous data point, in my opinion, that gives the Fed real discussion next week about pausing sooner than the market is expecting. Because really, the challenge on things declining, like we went through, stocks are down, bonds are down, real estate is finally breaking in a big way. The Fed did their job. And if we look historically at how quickly they've raised rates this time around compared to any past cycle, I think it's interesting to have that discussion with them. So if you look at the graph of the pace of interest rate hikes, I think it's interesting to look at that here, Michael.
Right, because one thing that you'll see on this graph is when we look at just the slope of the line for 2022, the sort of the bold orange line on the left, this is the fastest the Fed has ever raised rates. And when you look at what they've done, you go back to between 2015 and 2018 on the far right, we're essentially where we are then from an interest rate perspective, but instead of getting there in 3 years, we got there in 5 months. And what the Fed hasn't done is given the market a chance to breathe. They haven't given the chance for companies, for individuals to really take a look at what their costs are going to be, and from a planning perspective, how they should be budgeting. And that's really what I think a lot of companies are looking for, is to kind of take a break, see what their costs are going to be for operating their business, for capital expenditures, moving forward. And if they can have this idea of where the rates are going to be and what those costs are going to be, they're going to be able to make more strategic decisions for moving forward. And again, from a company perspective, from an individual perspective, it could be, do we want to build this new factory? If we're going to spend $10 billion on it, if rates are going to be higher, maybe we cut that back. And then going back to housing for individuals, if we know mortgage rates are going to be here, maybe that says, all right, well, we can afford this much house. But if they're going to be a little bit higher, maybe we want to bring that that number down as well. So I do think it kind of brings back, if this really opens up the opportunity for the Fed to take a pause, maybe that idea of a moderate soft landing is still possible. Because when you look at the overall economy, the economy is still in pretty good shape. You've got a strong labor market, wages are up, and things really aren't that bad from that overall picture.
And if you look what's ahead, you're going to have a GDP for third quarter that's going to be somewhere around 3%, probably 2.8, 2.9 range. So to your point, the economic growth has been strong. Service spending, experience spending has been fantastic, the last 3 months or last quarter overall. And when you look at the Fed next week, they're going to probably raise 3/4. So, and that makes sense. You're catching the very short-term interest rates up to where the rest of the interest rate curve is. But from there, that's where you think that the changes should happen. And when you think about the risk reward of the market at this point, because you could take the other side. We've been talking about this all year. Don't fight the Fed. But when can you get back in fast enough, Megan, if the Fed does pivot, if there is data, if we take the Fed at their word, they're really going to look at a lot of this stuff. Where are the opportunities as we look at things? And the risk reward seems pretty compelling to start to take on some risk assets again.
I mean, there's still definitely a lot of opportunities even today, and we'll dig a little bit deeper into a specific one with current cash outlays. But in addition to that, we think as long as you keep the PE low and you're looking to value companies that are sitting on a little bit more cash or have a little bit more of a runway to kind of wait out how long this period could last, that's a good place to lean into. Obviously, growth has been sucked out of the system already and probably will continue with the Fed hiking at this rate. So value stocks and that overall trend, we're looking into the value cycle, moving out of the high growth cycle from the past few years at this point.
So as we kind of look to conclude before we talk about the planning idea, it just feels like it's been a very tough year. The Fed did a lot of the pain points of causing inflation to really trend and get to that symmetrical downward that looks like is clearly ahead in a lot of ways. And again, if we're wrong near term and the Fed really sticks to where they've been, still the risk reward to the downside is less, especially if you look at that midterm historical performance, and it could set up very nicely for looking at. And the reality is you have a lot of stocks down 50 to 70%. So to be buying a lot of those value and dividends you're talking about, Megan, seems pretty compelling from a longer term standpoint of where to go. And the same thing with the bond market. Given where
I was
interest
going to
rates
say, we finally have yield back in the system. So, but I think more specifically, individual bonds is probably the safest place right now, because as interest rates continue to rise, bond funds and ETFs trade a little bit more like a stock. So they aren't going to be as nimble as bonds that will mature, or that you can hold till maturity. So the loss in effect is just unrealized.
And to your point, it's been the worst bond market ever, right? Now let's turn to the planning idea, given that it's been the worst bond market ever. As we're talking to many of you, a lot of people are sitting on more than normal amounts of cash.
Right. And what you're seeing, so what we've started doing, or what we have done for some clients, is have this cash management strategy where the idea is to have, a rolling laddered portfolio of bonds, either looking at treasuries, munis, or corporates, and look for that sort of best or highest tax equivalent yield. And depending on sort of which category, and you're looking at a 4.25% to 5.25%, rate of return. That yield is, as Megan said, we finally got some yield back in the system. And what we've liked about this strategy is that we're able to do this with very high, high rated bonds, the highest quality. And again, depending on what you're looking for from either a taxable perspective or muni perspective, can really change where you are. But for the longest time, we were saying, if you're getting a little bit out of this strategy, if you're maybe getting 1.5%, it wasn't that big of a deal over what you were getting sitting in your money market fund or just plain cash in your savings. Now you're getting some real return. And this is just a way that we're saying, in a market period like we're seeing, this is a good opportunity to generate a little bit more safe yield on your cash holdings. And that when it does make sense to, get back in the market, that you have that liquidity there for you as well. So it is something that we recommend looking into if you do have some substantial cash holdings, just as a way to increase your cash flow and give yourself a little bit more opportunity when the tide does turn.
And with that, we want to thank everybody for tuning in this month and listening. And again, as we summarize, it's been a very, very tough period on everyone from inflation and risk assets. But the risk reward is compelling now to really start to look for opportunities and to lean a little bit more. And if you have all that cash sitting in your bank account, this is the highest yields we've seen in 15 plus years. So it's good to consider some of these from a planning perspective as well. And with that, we'll tune in next month. We'll see how the elections turn out and see kind of where we play out into the end of the year. Thank you.
Thank you, everybody.